It wasn't a sudden spike in industrial demand for solar panels. It wasn't a coordinated speculative attack by retail traders. It wasn't even a geopolitical supply shock from a single mining region. It was the mathematical inevitability of a paper derivative market colliding with physical reality. The price on the screen is a claim. The metal in the vault is the truth. For 40 years, the claim and the truth were allowed to diverge. Liquidity masked solvency. Paper contracts masked physical deficits. But history shows that every dual pricing system eventually snaps. When the premium for physical possession detaches from the spot price, the illusion dissolves. We are witnessing the end of the paper epoch. The arithmetic is merciless. The vaults are not empty, but they are encumbered. 517 million ounces sit in the dark, but who owns them? How many times has each ounce been sold? The pattern is unmistakable. We have seen this specific sequence of inventory depletion and price discovery before. It destroys empires. It rewrites ledgers. It transfers wealth from those who hold promises to those who hold mass. To understand why silver breaking $70 is not an anomaly but a return to equilibrium, we must look backward. We must examine the mechanics of three specific historical collapses. In each case, the authority tried to manage the price of money. In each case, the physical reality asserted itself. The market always wins. The incentive is always to print. The result is always a run on the vault. This is not a matter of opinion. It is a matter of weight and fineness. We begin in the 1st century with the most powerful economic engine of the ancient world. The Roman Empire did not fall in a day, but its currency began to die centuries before the legions retreated. The death of the silver denarius is the definitive case study in the separation of face value from physical value. Under the reign of Nero, around 64 AD, the imperial treasury faced a fiscal crisis. The costs of rebuilding Rome after the Great Fire, combined with the immense expense of maintaining the legions on the frontier and the grain dole for the populace, exceeded tax revenues. Nero faced a binary choice: cut spending, which risked mutiny and riots, or find new money. He chose the latter. He did not have central banks or digital ledgers. He had the mint. Nero ordered the silver purity of the denarius reduced from 100% to roughly 90%. He also slightly reduced the weight of the coin. To the average shopkeeper in the forum, the coin looked the same. It bore the emperor's image. It had the same legal tender status. But the physical reality had changed. This was the first step in a centuries-long process of structural theft. The incentive was irresistible. By reducing the silver content, the state could mint more coins from the same amount of bullion. It was free money, or so it seemed. The process accelerated under Septimius Severus in the late 2nd century. Severus famously advised his sons to enrich the soldiers and scorn all other men. To pay for this enrichment without raising taxes, he debased the currency further, dropping the silver content to approximately 50%. The soldiers, however, were not economically illiterate. They lived on the margins of the empire, trading with merchants who cared only for the metal, not the face on the coin. As the quality of the coin degraded, merchants demanded more coins for the same goods. This is the mechanical definition of inflation. It is not prices going up. It is the currency going down. By the time of the crisis of the 3rd century, the situation had spiraled into chaos. The Emperor Caracalla introduced the Antoninianus, a coin valued at 2 denarii but containing only 1.5 times the silver. It was a formalization of the fraud. The public reaction was immediate and rational. Gresham's law took hold. Bad money drove out good. Citizens hoarded the older, higher purity coins and spent the new, debased sludge. The vaults of the private citizens held the real wealth, while the circulation was flooded with copper washed in silver. By the reign of Gallienus in the 260s, the silver content had collapsed to less than 5%. The coins were essentially bronze tokens with a thin silver wash that rubbed off after a few weeks of use. The state had attempted to defy the laws of supply and demand. They insisted that a piece of bronze was worth a day's labor. The market disagreed. Prices for wheat, which had been stable for nearly 2 centuries, exploded. In the 2nd century, a measure of wheat might cost 7 or 8 drachmae. By the late 3rd century, that same measure cost 120,000. The social fracture was absolute. The middle class, the decurions who formed the backbone of local civic life, were wiped out. They held cash savings, which evaporated in value. The wealthy elite, the senatorial class, had already moved their wealth into land, slaves, and gold bullion. They insulated themselves from the monetary collapse, retreating to self-sufficient estates that would eventually become the manners of the Middle Ages. The economy deglobalized. Trade routes withered because no one trusted the currency used to settle accounts. The Atlantic treasure fleets began to carry hundreds of tons of silver back to Seville every year. They believed they had solved the problem of financing their wars against France, the Ottomans, and the Protestants. But they made a critical error in their accounting. The cost of living in Spain skyrocketed. Despite owning the richest mines in history, Philip II declared bankruptcy 3 times, in 1557, 1575, and 1596. The lesson from Spain is that an increase in the monetary base, even if it is hard currency, without a corresponding increase in production, leads to a breakdown in pricing power. The market eventually discounts the new supply. Just like the Spanish liquidity crisis, the Weimar Republic in the early 20th century demonstrates the final, violent phase of a currency disconnecting from physical reality. The tragedy of Weimar Germany is often simplified into a story of printing presses running hot, but the mechanics were more subtle and insidious. In 1914, at the outbreak of World War I, the German government suspended the convertibility of the mark into gold. They created the Papiermark. This was the original sin. The government believed they would win the war and pay off the debt with reparations from the defeated allies. They lost. The flight from currency into hard assets was swift. It happened in stages. First, people bought foreign currency dollars and pounds. Then, as capital controls tightened, they bought anything tangible: pianos, machinery, antiques, and real estate. But the most critical asset was the necessities of life. Farmers refused to sell their produce for paper marks. They hoarded potatoes, wheat, and milk. They would only trade for goods or foreign currency. The supply chain bottleneck was total. The city dwellers were starving not because there was no food, but because the transmission mechanism, the money, was broken. In November 1923, the price of a kilogram of rye bread reached hundreds of billions of marks. But the price in gold or silver remained relatively constant. The volatility was not in the commodity. It was in the denominator. The middle class was wiped out. Pensioners who had saved for a lifetime found their savings could not buy a cup of coffee. The most striking phenomenon was the crack-up boom. The stock market in nominal terms soared to astronomical heights. People felt rich as their portfolios added zeros, but in real terms, the value of the companies was collapsing. The factories were idle, the inventory was gone. It was a paper illusion. The stabilization came only with the introduction of the Rentenmark, a currency theoretically backed by the land and industrial plant of Germany. It was a psychological trick, a reset. But it worked because the government stopped printing. They accepted the pain of high interest rates and fiscal discipline. The holders of the old paper were ruined. The holders of physical assets, land, factories, gold, and silver survived. The pattern was complete: denial, expansion, acceleration, collapse, and reset. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is a certificate of deposit for a physical asset. A dollar is defined as a specific weight of silver or gold. Trust is high because the constraint is physical. Governments operate within their means because they cannot print metal. The economy grows based on productivity and savings. Stage 2 is layering. The state or the banking sector introduces claims on the metal that exceed the physical supply. This is fractional reserve banking, or the issuance of unbacked treasury notes. It is sold to the public as a convenience or a temporary measure for stability. The population does not notice because the paper still trades at par with the metal. The seeds of the bottleneck are sown here. Stage 3 is debasement. The state faces a fiscal crisis war, welfare, or corruption. The temptation to utilize the gap between paper and physical becomes policy. The gold window is closed or the silver content is reduced. The currency becomes fiat, backed only by the decree of the state. The money supply expands faster than the economy. Stage 4 is asset inflation. The newly created money does not flow evenly. It flows first to the financial sector and the government contractors. This is the Cantillon effect. Stock markets, real estate, and bond prices rise. The rich get richer. The public is told this is prosperity. The velocity of money is still low, so consumer price inflation remains muted. Skeptics who warn of the disconnect are mocked. Stage 5 is price acceleration. The money begins to leak from the financial assets into the real economy. Supply shocks, often caused by the misallocation of capital in the previous stage, trigger price hikes. The public begins to notice that wages are not keeping up with the cost of living. The government blames speculators, greedy corporations, or foreign adversaries. They implement price controls or subsidies, which only restrict supply further. Stage 6 is the flight to reality. This is the psychological tipping point. The public loses faith in the store of value function of the currency. They begin to trade paper for anything that cannot be printed: gold, silver, land, art, commodities. The velocity of money explodes as no one wants to hold the hot potato. The premiums for physical coins over paper spot prices widen dramatically. The vaults are drained. Stage 7 is the reset. The currency is either destroyed through hyperinflation or reformed through a hard default. A new unit of account is introduced, often pegged to a hard asset or a foreign currency to restore confidence. Wealth is not destroyed, it is transferred. Those holding paper lose everything. Those holding physical assets dictate the terms of the new system. Just like the flight to reality in Weimar Germany, we are seeing the early signals of Stage 6 in the modern silver market. The headline figure of 517 million ounces in the COMEX vaults is a data point that requires forensic dissection. To the casual observer, it suggests abundance. But in the world of futures contracts, the devil is in the classification. The COMEX divides inventory into registered and eligible. Eligible silver is metal that meets the purity standards and is stored in a COMEX-approved vault, but it is not currently available for delivery against a futures contract. It is owned by someone, a private investor, a bank, a corporation who has not issued a warrant for it to be sold. It is effectively off the market unless the owner decides to sell. Registered silver is the metal that is actually available for delivery to settle contracts. This number has been trending downward, creating a precarious leverage ratio. The ratio of paper ounces, open interest contracts, to registered ounces is the metric of vulnerability. When this ratio stretches, as it has, it implies a game of musical chairs. If even a small percentage of contract holders stand for delivery, the registered stocks could be wiped out in days. The mechanism of the squeeze is driven by the divergence between the spot price and the physical acquisition cost. We have seen periods where the spot price languishes. Yet the premiums on physical coins, silver eagles, maples soar to 30 or 40%. This is the market screaming that the paper price is false. It indicates that the supply chain for retail investment silver is broken. But the wholesale market is where the real fracture lies. Industrial demand is the relentless floor under the market. Photovoltaics, electronics, electric vehicles, these are not optional technologies in the modern green energy paradigm. They are government-mandated consumption. Silver is the most conductive element on Earth. It has no substitute in many high-tech applications. As governments push for net zero goals, they are mathematically mandating the consumption of silver. But the mining supply is inelastic. You cannot spin up a silver mine in a month. It takes 10 years from discovery to production. The supply curve is flat, but the demand curve is vertical. The counterargument is always the same. There is plenty of above-ground silver. Critics argue that if the price rises, grandmother's silverware will be melted down and the supply will flood back in. They point to the 1980 Hunt Brothers episode as proof that squeezes fail, but the incentive structure has changed. In 1980, silver was largely photographic and decorative. It was recoverable. Today, silver is industrial. It is consumed in trace amounts in billions of devices. It ends up in landfills. It is strategic. Furthermore, the above-ground stocks argument ignores the ownership structure. The 517 million ounces in the vaults are not a public utility. They are private property. If the owners of that silver, likely smart money anticipating the currency debasement, refuse to sell at $70 or even $100, the paper market cannot fulfill its obligations. The risk is a failure to deliver event on a major exchange. If a major industrial user or a sovereign wealth fund stands for delivery, and the exchange settles in cash because they cannot find the metal, the confidence in the paper price collapses instantly. The price of silver would bifurcate: a paper price that is irrelevant, and a physical price that is discovered in private transactions at a massive premium. This is the unobtainium phase. Most observers agree that the current geopolitical environment accelerates this trend. Central banks are buying gold at record rates. Silver, as the erratic cousin of gold, typically lags and then slingshots. The gold-silver ratio, historically around 15-1, sits at levels that suggest silver is mathematically cheap relative to gold. In a world of currency debasement, capital seeks the most undervalued hard asset. The arithmetic suggests silver is the tightest market with the highest explosive potential. The endgame approaches in three potential forms. The first is controlled decline. The central banks manage the repricing of silver slowly. They allow the price to rise to triple digits over a decade, masking the move with general inflation. This is financial repression. The debt is inflated away and silver holders preserve their purchasing power, but there is no sudden snap. This requires a level of coordination and competence that history suggests is rare. The second is chaotic collapse. A sudden loss of confidence in the dollar or the bond market triggers a rush into commodities. The COMEX declares force majeure. The paper market closes. Trading moves to Shanghai or a decentralized physical network. In this scenario, silver does not just rise, it revalues. It ceases to be a commodity and becomes a monetary asset again. The anchor date for this kind of event is akin to the closing of the gold window in 1971, but forced by the market, not the president. The third is reset and restructure. Governments acknowledge the debasement and peg their currencies to a basket of commodities to restore trust. Silver, along with gold and oil, becomes part of the new reference rate. This happened in Germany in 1923 and in Bretton Woods in 1944. In this scenario, the official price of silver is set significantly higher to liquefy the system. The only variable is timing and pain. If you are holding paper promises, you are short the squeeze. If you are holding physical metal, you are the bottleneck. The history of Rome, Spain, and Weimar screams the same warning. When the vault does not match the ledger burns. Subscribe, and pay attention to the premiums, not the spot price. The premiums tell the truth.